Good morning, everybody, and welcome to the Finance Indaba Network webinar. I see our numbers are slowly climbing, so I'll give the audience a few seconds to join the webinar, and then we can kick off. In the meantime, if the audience could let us know who you are and which organization you represent, that'll be great. See, the numbers are climbing nicely, so we'll give the audience a few more seconds. We've got a few people and they're joining quickly now. Welcome, Donald. Welcome, Gloria. Perfect. So I think I'm going to kick off, and there will be a few more people joining as we go along. So again, welcome to everybody. Thank you for joining us. And today we're going to be mastering IFRS 9 during COVID-19. It'll be a case study calculating expected credit losses for corporates. We've got a great panel lined up for you today. So if I can welcome our panel to come on camera, I'll be able to introduce them. There you go. Good morning.
Good morning.
Hi, good morning.
Hi, good morning, Tamara.
Hi there. Perfect. So to the audience this morning, we are joined by I9 Partners and a case study with Etion. So our panel today consists of Rosh Segal, co-founder and director of I9 Partners, Lawrence Milner, co-founder and director of I9 Partners, and Narishni Naidu, the group financial controller of Etion. So thank you for taking the time to meet with us this morning. And I'm looking quite forward to learning a bit more about IFRS 9. I think to get things started, and I'd really like to encourage the audience to participate, keep an eye on the polls. We'll be hosting a few polls. And I think we're going to kick off with the first poll. So if you can keep your eye on that, I'm going to start the poll now. So you should be able to see it. You can go ahead and make your selection. The question is, do you expect your ECL post-COVID to increase by, I don't know, less than 10%, 10 to 25%, 25 to 50%, or 50 to 100%? I see the polls are moving, so that's great. We'll give you a few more seconds. I'm going to end the poll in a few seconds, and then we can have a look at the final results. Right, let's end that poll. And the results are as follows. So majority voting 10 to 25% is the expected ECL to increase post-COVID. Rosh, Lawrence, any comment on that? Does it surprise you?
Law, do you want to kick off?
Oh, you're on mute, Lawrence?
So while Lawrence is on mute, never been one to miss an opportunity to talk. So I think 40% of you were in the 50 to 100% increase band. And the really nice thing is that you are probably the closest and probably out by between 8 and 10 times. So those of you who are below that are out by somewhere between 20, 50, and 100 times. And the real numbers could be anywhere 2 times, 4 times. We've seen a lot of numbers even higher than that, especially if there's stage transition. So very volatile. The numbers are jumping tremendously, and we look forward to sharing some of the thoughts around that.
Perfect. So one more poll before we kick off with you, Rosh. So the next one is, do you know which factors to consider when calculating your company's ECLs in a post-COVID environment? So if the audience could let us know their selection. See, the polls are quite busy, so let's give it a few more seconds. Okay, it seemed to slow down. Let's have a look at those results. So yes, 100% comfortable was 11%. Majority coming in at 52% is partially, we need some outside assistance. And 35% of the audience says no, the requirements were more complex than we anticipated. Again, do these results surprise you?
No, they don't. I think that it is very challenging to determine what factors have changed in a COVID-19 environment, and just the inherent nature of expected credit loss calculations being forward-looking, being very sensitive to the environment. It doesn't surprise me at all that if we take the options B and C, that constitutes the vast majority of the participants.
Perfect. Okay. I think we can kick off with the session. So, Rosh, you will be demystifying the current IFRS 9 landscape and reveal which essential factors to consider when calculating ECLs. So, Rosh, over to you.
Thanks, Tamara. Obviously, COVID is a time of huge human loss and suffering, and it also brings a lot of economic tragedy and uncertainty, and also new situations. For example, debtors who've asked for deferrals. There's so many, and will they be able to dig themselves out of the hole and eventually be able to repay? Also, what happens when a business can't meet their bank requirements or the bank covenants? That is the ratios that account holders promise to meet and promise that they won't break. And the bank facility often depends on that. Will the lenders or the bank condone the breach for a short period, or will they call up or want to renegotiate the facility? Does this breach mean that the company is now in stage 2? Has there been an SICR, a significant increase in credit risk? And if there are, when will this reverse and become stage 1 again? How do you account and measure for the guarantees that group companies have made as part of this bank facility agreement? These are just some of the situations and questions that arise in this new environment. But the key thing and the key takeaway, as we'll see later, is that COVID magnifies all the numbers. Auditors are understandably both nervous and cautious. If a company in a group fails, it can bring the entire group down with it. And then all the numbers are under scrutiny. We can see that with the recent impact and unraveling of the Tongaat Hewlett Group. It destroyed so much wealth for shareholders, but also the careers of lots of auditors and accountants. So it's definitely a time of caution and a time to be aware of this magnification that you'll see. So just a couple of concepts to give context early on in the session. And the first one is a PD curve. So when something is in stage 1, we know that the standard says we use 12-month losses. And that means taking the probability of defaults in the next 12 months. When you go to stage 2 and look at lifetime losses, you look at the PD over a much longer period of time, and it works out to be several times the level of a 1-year PD. And the difference between that could be even 3 or 4 times. In addition, the curve is not a straight line. The curve is logarithmic, grows sharply, and then levels out or flattens over a period of time. Something that we talk about quite often is a word called conditioning. And there are many terms for this, But the basic concept is that you take a historical through the cycle loss measurement, you then change it to a point in time at the measurement date, and then IFRS 9 says you need to make it forward-looking. So to make it forward-looking, you take the point in time at your end and you change or condition it to reflect the expected change in the number that will arise from the expected change in the economy or in circumstance. This is what you use the macroeconomic forecasts and scenarios for, as well as the models that predict how much the factor will be. So Moody's refer to this as conditioning. Some refer to it as FLI, or forward-looking indicators, or even an FLI scalar, the factor by which your past measure becomes the future ECL. For example, is it 0.5? So is it lower this year? Is it 2 times? Or is it even 6 times the past? So the biggest issue, as I've said, is one of magnification. And what do I mean by that? If you start off with a historical or through the cycle measurement of, say, 1%, and assuming you then change stage and need to look at lifetime losses, the 1% gets magnified to, say, 3 or 4%. If then you put in these forward conditioning factor of another 3 or 4 times, your 1% turns to 3 and the 3 turns to 12. That's a huge jump from the 1%. But if your starting point is 2%, which under normal circumstances, the 1 to 2% wouldn't make a huge difference and wouldn't be a material amount, but you multiply the 2 by the 3 to get your lifetime losses, which become 6. You then multiply that by the 4 times FLI conditioning factor, and you get 24%. So last year, you may have started off with a 1%. By choosing the wrong starting point, or choosing a starting point of 1 versus 2, you can move from a 1% to a 24%. And even the difference between the 12 and the 24 of the 1% difference is a huge number. So COVID magnifies all these areas. So the starting point in all your through the cycle measurements is critical because of that magnification, and you go from there. So that also comes through in trade receivables books. We see many people who fail audits on IFRS 9 or who come up with numbers that look really out because they've been based on yesterday's IAS 39 principles. One of the issues that we see is that they often use only 1 year's worth of losses in history. And there's so many items which can distort a short period. For example, large credit notes, or a change in practice from a change in staff. Someone goes on holiday and it leaves payments unmatched for a while. It's like actuaries trying to work out life expectancy tables on only 1 year's worth of data. There's a chance you're going to get it right, but there's a chance that you're going to get it very wrong. If you don't have a history, you should expect volatility, and volatility isn't something that you want to have in your starting off data. Another thing is the fact that write-offs are generally very misleading. When a company writes off an amount, it often relates to losses that were incurred many years ago. So you actually don't know what 1 year's write-offs actually are. And that's one of the reasons that we try and start off with a 60-month history and then grow it from there. Now, to do this, you obviously need the tools to do this. So we can generally take a 60 separate age analyses, even if they're in slightly different formats, combine them, check them, do the overall analysis in about an hour or so, and then get a great history to get a reliable and justifiable result based on a very, very strong starting point. So credit losses and techniques are issues that us as accountants aren't really trained for or equipped to deal with. They're very different. The experience comes from people who work in banks. And we spend a lot of time debating these issues with specialist teams at the Big Four. So the Big Four all have specialist teams that work on credit risk to complement their processes and limit their risk. And we also speak to heads of various departments at banking institutions to find out what the trends are in different scenarios. But overall, everything we do is based on data, and is based on methodologies and techniques that put out reliable and justifiable numbers. So what's changed in the last year, I suppose, and in a COVID environment? So the first thing is guarantees. So guarantees have become a hot topic, partially because they weren't done well in the first cycle of IFRS 9 implementation, or in some cases they weren't done at all. Also because in 2019, and this is before COVID, due to the poor economy, many companies had issues meeting their bank covenants. And now post-COVID, this has become really visible. So breaking these covenants creates a significant increase in credit risk, and almost certainly means you move on to stage 2. And COVID now means that a huge amount of companies will now not meet these covenants. And stage 2 means lifetime losses, which amplifies the ECL. So there's that magnification impact again. When we started I9 Partners, we were lucky to persuade Moody's Analytics out of San Francisco and London to be their partners in South Africa. We traveled to San Francisco and to London to meet with the people, to meet with the teams, to build the right IFRS 9 tech methodologies for companies, because they were very focused on banks. And we were really impressed to see their huge teams of credit experts, of economists, of statisticians, of modeling experts. And it's quite intimidating and awe-inspiring to see these global organizations and the level at which they can do things. One of the really cool things about it is they've got huge pools of global data and the expertise to be able to work out the trends and the impacts on credit risk. They're particularly strong in South Africa because South African banks actually contribute to an anonymized pool of South African data that the banks then reuse after Moody's builds new models based on it. And it really looks at the predictive relationships between financial statements, macroeconomic data, and credit losses. We also use Moody's macroeconomic data and 3 scenarios that they produce from a number of different sources to get 3 separate outcomes on all of our IFRS 9 ECL calculations. Those 3 scenarios then get weighted, and they also give us really interesting views on how sensitive a ECL calculation is to various economic scenarios. So Moody's have got millions of data points in SA alone over a multi-decade history, and it's a tool set trusted by and used by SA banks, regulators, and audit firms. So the messages here are measure over a longer period of time to minimize the volatility in your starting point. If your starting point isn't where it should be, everything goes south from there. COVID forward conditioning may multiply your historic numbers by easily 2 to 4 times. So in some of the large listed groups that we've worked with now, because auditors are so cautious, they've often argued for really high multipliers. We've even seen them argue for 7 times in some particular areas. So really be aware, this is a time of big change. So to reflect again, a change in stage means lifetime losses and may multiply to 3 to 4 times. So we've seen 5% change to 50%. We've seen some crazy numbers. This is not a year in which you should expect your ECLs to go down at all. 18 to 24 months ago, we saw ECLs come in at somewhere between 0.6 and 0.9 times history in certain circumstances. Now we're talking about many, many more multiples. So some of your items that you calculate, say, a 50% ECL on will actually not make it. They'll turn out to be 100% in the next year or so, and everything will get lost. But it's important to remember, just like people value shares, there's no such thing as perfect foresight. You're not going to get all the factors right. But it's important to go through a robust process and work out what your likely losses are going to be based on history, based on sound techniques, and in a way that you can justify. Many of those ECLs should hopefully reverse over the next couple of years. So as something moves from stage 2 back to stage 1, obviously it moves back down to 12-month losses and improves. And some may take a little longer to start to level off as individuals and companies struggle to repair the big holes in their balance sheets that the 6-month hiatus in business and the much lower levels of economic activity have created on their results in their balance sheets. Tamara, are we going to look at another survey now before we hand over to Narishni?
Tamara, you're on mute.
Thanks, Lawrence. I've just loaded another poll. So I have experience calculating an ECL on trade debtors, intercompany loans, loans to third parties, guarantees on group banking facilities. I haven't had to calculate an ECL yet. So let's see what the audience says. Okay, I'm going to end the poll in a few seconds. Right, results are in. So very even split between trade debtors, and I haven't had to calculate an ECL yet. So quite interesting. So Rosh, any comment on those results?
No, I think that's probably fair in terms of what we've seen. A lot of people, because they are used to calculating provisions on their trade debtors, have now continued that. Whether it qualifies as an actual ECL instead of just the old traditional IAS 39 way of doing it remains to be seen. And intercompany loans, loans to third parties, and guarantees are really so difficult to do without the right tools. So that really doesn't surprise me.
Okay, fantastic. Thank you, and thank you, Lawrence.
Yeah, just add a very short comment on that. What we've noticed over the last 12 months is that it's probably the intercompany loans and the guarantees are the biggest focus of auditors on IFRS 9 at the moment.
Fantastic. Thank you, Lawrence. And I think we're ready to hear from Narishni. Narishni represents Etion, and she's going to discuss how her company overcame its challenges with ECLs. So thank you.
Thanks, Tamara, and thanks to Rosh for, I guess, kicking us off. Just in terms of, I guess, sharing a little bit about Etion, we are a diversified technology group. We listed on the AltX, so a small to medium cap entity. We have 3 operating subsidiaries within our group structure, 4 dormant or let's say lower trading entities or entities that do not trade as often. And then we have a division within our listed entity, within the group, or within the listed entity rather. From a group perspective, we operate across many sectors and industries, including telecommunications, mining, financial services, as well as the defense sector, and we do quite a bit of work in the government sector as well. Our group consists of 4 business units, one of them being Etion Digitize. That's a safety and productivity solutions entity. They essentially focus on providing solutions to the rail and transport industry in terms of tracking assets, ensuring that they're working efficiently and operating effectively. We have a cybersecurity business, Etion Secure, which looks at preventing and identifying any cybersecurity risks within organizations. We also have a telecommunications business, Etion Connect, which provides passive connectivity solutions and equipment to the telecommunications companies. And then our last business unit is Etion Create. That's our original design and manufacturing arm of the group. And that entity essentially focuses on providing bespoke solutions and systems to clients within the defense and the aerospace segment, or let's say industry. We have a 31 March year end. So as you can see, based on my description of all the different business units within the group, we have quite a big portfolio of different customers. Our customers are usually very diverse. And in that, our financial assets that sit on our balance sheet are also quite diverse, ranging from trade receivables. We have some intergroup guarantees, contract assets related to those trade receivables, as well as intergroup loans and loans to related parties. So I guess being a small to medium cap listed entity, we have a very small finance contingent with very limited resources and I guess expertise and capacity to really take on big projects, such as implementing a new standard. So our relationship with I9 essentially started back in 2018 when we had to implement IFRS 9 for the first time. They essentially helped us with the implementation, calculating our ECLs using the Moody's model that Josh sort of went into earlier on. And I guess we've built a relationship over the last 2.5 years now. It's been really good to work with the team. They develop a good understanding of our customers, our business, and I guess it's been a pleasure from that perspective to work with them through the transition. And now, in these uncertain economic times and the complexity that is COVID, I think based on the description, like I said, of our different business units, I'm sure you can appreciate that our debtors books are quite very diverse. Some of the BUs are concentrated around a specific customer, whereas the other BUs are more spread out or widespread. We also have international as well as local exposures to SOEs. So it's quite a complex debtors book, even though we quite a small entity from that perspective. What we found is that it works best to calculate our ECLs based on the different business units. So generally our ECLs are calculated per business unit. If we have any specific exposures, we normally calculate our ECLs specifically for those exposures if they have a different credit risk to the rest of the general debtors book. And what we have found is that there may be certain instances based on management's interaction with the clients or what we've heard around the industry in which those customers operate, that an additional overlay that may not necessarily be captured within the Moody's model that we apply is necessary. And as a result, we also sometimes then apply our own management judgment to the ECLs that are forecast using the Moody's tools. I think in terms of COVID and how that's affected our business, it was quite interesting looking at the poll to see how people kind of perceived COVID to impact their business and their accounting with regards to ECLs. And I think, to be fair, we did the same thing. We totally, let's say, underestimated the impact of COVID on the business and the need to account for it. And it ended up being a lot more complex than what we had actually anticipated. Having a 31 March year in, we were almost right in the thick of things. The national lockdown was announced on the 26th of March. And as a result, it was considered to be a pre-balance sheet event. So any factors or circumstances or any sort of information that came into light, even after year end, had to be taken into account when we were calculating our ECLs, as it was now a pre-adjusting balance sheet event. So that added another complication, I guess, to our ECL, to our, I guess, year-end process and ensuring that our ECLs were appropriate. Essentially, what we then did from an organizational perspective is we engaged with our customers earlier on, tried to understand what the impact of COVID would be. Would they be a likelihood they'd default? Did they perhaps need an extended payment term or any sort of extension to their payment plan? We also looked out in the media, looked at the industries in which our customers operated to try and understand how those industries were being impacted by the lockdown and the advent of COVID. But we also did is we tried to monitor all our post-balance sheet receipts in order to track, did we see a pattern or a trend emerging where customers were not able to pay, they were defaulting, they were paying later than we expected. And I guess we were maybe in a lucky space, or let's say operating in an industry where we fortunately did not see a lot of that, and generally our customers still honor their debts and paid according to their usual payment terms, even with COVID. We were lucky in the sense that almost all of our business units were able to operate during COVID. We were classified as essential service. So I guess in that way, as much as there were more things to consider, it was just about closing the loop and ensuring that we considered all the factors that were appropriate. When we did pick up that certain debtors had maybe had an increase in the credit risk post year in based on the information that was out there in public domain, we then, as I mentioned earlier, had to do some sort of management overlay to account for that extra risk in order to ensure that our ECLs were appropriate and appropriately represented the risk that was associated with those particular debtors or customers. And then I think Rosh also touched on it. The auditors are also a lot more careful. They are a lot more detailed in terms of the work that they performed on trade receivable and or not only trade receivable, actually all the ECLs that existed throughout the group across our various financial assets. We found a lot more detailed worked questions, conversations needed to be had with the auditors in order for them to be satisfied that our level of provisioning was appropriate. We were requested to do a lot more robust disclosure around, especially around how we had determined the credit losses, the management overlays that I mentioned in these uncertain times. What were the factors we took into consideration? What were the circumstances that exist? Why we're comfortable that our ECLs are appropriate? So what we found is that we had to do a lot more robust disclosure, even though we had implemented the standard in the previous financial year. There was a lot more rejigging of our disclosure that had to happen over this period with the impact of COVID in order to make use of the financial statements, understand the economic uncertainty that exists as a result of COVID. So I think that was a lot more complex and involved a lot more work than what we anticipated. So, and I thought it was quite interesting that when people had mentioned, that they thought they had a handle on it or had done some work. I think what we learned is that we had thought we had prepared in advance and tried to understand as much as we could through the various platforms and reading and attending the various training sessions, etc., that are offered. However, I think it's only when you actually have to do it and get everybody over the line and ensure that your financial statements have the proper disclosures, etc., that you realize the amount of work that it actually takes, and it can be a bit more complex than anticipated. In terms of, I know Rosh mentioned that we, with the Moody's model, there are 3 scenarios that are typically used to calculate the ECLs, and they are weighted. We were also requested to do as part of our disclosures, a little bit of a sensitivity analysis, and that was actually very helpful in terms of having the 3 scenarios available under the Moody's tool. And as a result, what we essentially did is instead of weighting the scenarios, we had applied 100% scenario, 100% rather probability to the scenario, so that we could actually see what the impact of the different economic impact of the macroeconomic circumstances under those 3 scenarios would do to our ECLs. So I think it was really helpful to have access to those tools to be able to calculate that sensitivity and almost see what impact the different macroeconomic factors and GDP forecasts, employment, etc., would have against our ECL that we had eventually put forward in our financial statements. So we at least gave users that other element of information in terms of the sensitivities around the different scenarios, as well as what that would impact that would have on our ECL. And I guess if I look at using the Moody's model as a client and within the organization, because of having such a diverse debtors book as well as customer base, trying to do it provision matrix, or let's say a more simplistic provision matrix in-house, would not have appropriately captured the credit risk and the diversity as well as complexities that exist within our client portfolio and the industries in which we operate. So I think from that perspective, going with Moody's, using those tools has really been a good investment from a group perspective. And I think even in the instances where, like I mentioned earlier, we had to perhaps do a management overlay or apply some judgment in terms of the ECL from a management team perspective that were calculated by the Moody's tool. It was good to have a base to start from, that was credible and that had considered all the various factors, all important in respect to determining your forward-looking adjustment and all your forward-looking information. To have that as a base to start from as management team, so that we could then apply our judgments and overlays on that base. So I guess that's essentially where we've used Moody's as an entity, and I shared a little bit about Etion. Not sure if there's any specific questions in terms of what it was like as a client to use it, but I think from our perspective, we definitely see the benefits of using the tool, assisting us through this COVID period, and then working with I-19.
Narishni, I mean, obviously the first time we did it to explain to the various heads of each division, sort of the financial team there, took a while for them to get their heads around it, and they had to put information together. But this year, sort of the second and the third time, it would have taken them an hour or two. I mean, you put in a huge amount of time, but just reflecting now, each of the divisions, it was really easy for them. Narishni, I think you're on mute.
Oh, sorry about that. Yes, so the Rosh, you definitely hit the money. I think any new standard has been quite a complex thing to implement. So the first year was a bit complex. I think we were all trying to wrap our minds around standard, what the requirements were, and then essentially from your perspective and our perspective, we had to assist in terms of helping you to understand our business, our customer base, etc. However, I think since doing it and having two measurement periods, I guess, through our interims and our finals, we developed a good understanding of what information is necessary, what kind of information to feed to I-9, such that it will assist with the calculation. And this year, it was really, we almost got it to a streamlined place where it's, this is our updated information, these are the facts that you need to be aware of, and, please just help us do the calc. So I think that has definitely paid off and it was a worthwhile investment, even though it was maybe a bit complex and painful in the beginning.
Thanks, Narishni.
Thanks, Narishni. I think we can hand over to Lawrence, and Lawrence can explain to us the approach that I9 Partners took at Etion in 2019 and how it would now be adjusted to include COVID-19. Thanks so much, Lawrence.
Yeah, sure. Thanks, Laura. So let me talk a little bit about some of the specifics on that. So first of all, looking at the trade receivables, the interesting thing is that the basic measure, the techniques that were applied did not change all that much. So what we did is, as Narishni alluded to, we measured separate ECLs for each of their major business units. Those were identified as their separate risk buckets. What we then did was identify individually material debtors, which tend to be any debtor which constitutes approximately 10% of the balance or more, and we measured their risk specifically separately. For the balance of the book, which makes up the vast majority of the number of debtors, we base the measurement of probability of default and loss given default on the history of those debtors. So we look at, within Etienne, we're now up to a 7-year history for most of their books, and we look at month by month the flow of receipts from each debtor to identify which debtors go into default, and then what we recover post-default. So we've got a 7-year history. So the very interesting thing is, if you look at 84 period months, and you consider that at a March year end, perhaps the last month or so impacted on the latest information, the raw measurement of the PD and LGD does not actually have any impact from COVID-19. Now, that doesn't mean that we can just use that measurement as is. Similarly, when we come to measure the risk of specific counterparties, if we look at credit ratings in the public domain, we look at listed entities where we have financial statements in the public domain, and we make use of the Moody's risk calc model, which quantifies the probability of default and loss given default from an entity's financial statements. We apply those, and if you consider that the information that was available as of March 2020, we were not dealing with information that had yet been impacted by COVID. But everyone knows that at some point of time during March, there was a dramatic change to the economy and to the risk environment. So clearly, COVID is having a fundamental impact, but the numbers aren't yet reflecting it. So where that impact comes through is in 2 very important adjustments that IFRS 9 requires us to make. The first is the conversion from the historical through the cycle to the measurement of risk as of the balance sheet date, the point in time measure. And that is a technical adjustment factor that you apply, and it is based on whereabout within the credit cycle you are. So if you're going to use the average for the past 7 years, even if you've used a shorter period of time, say 5 years or something like that, you're not going to come up with the right number if you are using that as an average, and you need to transform that to your point in time measurement. So obviously the point in time as of 31st of March, the credit cycle had changed dramatically from 2 months prior to that. The second area where there is a fundamental impact of COVID-19 is in the forward-looking conditioning. So that is the overlay of the macroeconomic factors to convert your historic measure, which we've now transformed to a point in time as of Etienne's year end at 31st of March. And now we have to overlay macroeconomic forecasts. So we use the 3 forecast scenarios provided by Moody's Analytics, which they have identified based on factors specifically for the South African economy. And we're working very closely with them through the month of March and April as they were adjusting those forecasts. And the adjustments were very significant. They are pretty much in line with the consensus forecast, just to say that the base case scenario was a more than 7% decline in GDP. But I should emphasize that they don't use a single factor to determine the macroeconomic impact. They use multiple factors that they have identified as having correlated with credit losses within South Africa to explain it. So if we had simply used a single factor based on expectation of GDP, I don't think we would have completely captured the change in credit risk. Some of those other factors moderated the impact, other of the factors might have increased them. So just to point that out. So that is how we dealt with the trade receivables. Just to repeat, the bulk of the book is based on the history, and then we do the specific large exposures where we measure a specific counterparty probability of default and loss given default, and then goes through the same transformation to the point in time measure, and then conditioned with the forward-looking macroeconomic forecast to the expected credit loss. The other areas of Etienne that did require a fair amount of thought and were inherently quite complex, as they are for all companies at this point in time, are the intercompany loans and the financial guarantees. So what we did was we measured the PDs and LGDs based on the financial statements of the various entities, making use of the Moody's risk calc model, which quantifies the probability of default and loss given default. And again, we conditioned them with the forward-looking factors. We had to give careful consideration. There are reporting deadlines, and we were anxious to have year-end numbers that had as much information as possible. In normal circumstances, due to reporting deadlines, you might be tempted to want to work with prior to year-end numbers, say use 11-month management accounts, which is a legitimate way of measuring the risk. But with the COVID environment, we were under significant time pressure trying to use latest information. The other important point to consider is, even prior to COVID, auditors' attention has moved very much to intercompany loans. So it's loans to related parties, loans to subsidiaries, even though most of the loans are going to net off upon consolidation, they are important within the company's own financial statements. The other area of focus of auditors is the financial guarantees. And to a large extent, these were overlooked on the initial adoption of IFRS 9 by many companies, and auditors were not all that concerned. There was an assumption that they weren't going to be material. So what typically gives rise to these in most groups of companies is that as soon as you have single funding arrangements across your group, there are likely to be guarantees, cross guarantees issued by all the subsidiaries to your funders. These suretyships or some other form of guarantee, these fall within the definition of financial guarantee within the IFRS 9, and therefore you have to have an expected credit loss. The calculation on this is fairly complex. It is important to get it right, and it's a number which can be very volatile, particularly when the company moves into stage 2 and you open up the lifetime measurements in order to intercompany loans and guarantees. And if you look at the definition of a significant increase in credit risk, I think you can understand that many organizations at the moment do fall into that definition, and therefore all their intercompany loans and guarantees are going to be moving into stage 2 and subject to lifetime ECLs. That is a factor that you would definitely need to consider, and we had to examine quite carefully and assess all the circumstances that related to Etienne in making that assessment. And just to emphasize that the numbers involved here can be very large indeed in the context of the balance sheet. Even though they net off upon consolidation, there are a great number of subsidiaries and holding companies within listed groups at the moment that are reporting their holding company becoming technically insolvent due to the ECLs that they have to raise on guarantees and intercompany loans. You need to consider this because the holding company results are in the public domain. You also need to consider that subsidiary financial statements, although typically not in the public domain, are often used for supporting tenders and other things like that. And they are also provided to banks and lenders. I think it's important to engage with banks and lenders to explain to them what the impact is. They should have the technical understanding to be able to understand what these adjustments mean and why it's created a massive hole within the balance sheet. But it's certainly something that you shouldn't be ignoring. So I think I've covered just how the project changed this year. I think that the one thing I will say is the auditors are being a lot more careful, and we fully understand their position. They are having to sign off on financial statements, issue audit opinions, which include the IFRS 9 calculations, knowing that it is extremely difficult to measure expected credit losses at this point in time. So they're cautious. They are performing their own measurements with a lot of conservatism built into it, and they are questioning very deeply the methodology behind it. And just as a concluding thought, what I'd like to say on it is that the purpose of your expected credit losses are not to predict precisely what next year's bad debts are. What the purpose is to measure the risk that exists as of your balance sheet date. And the two are subtly, but quite importantly, different. So what is going to happen is there will be many instances where your expected credit loss provision bears no resemblance to what your actual bad debts are in future years. It may be more, hopefully, it may be less. What is important is volatility is an inevitable part of IFRS 9. IFRS 9 is inherently pro-cyclical. It is going to change. If you've got flat provisions, you're doing it wrong. And anyone who looks at those numbers is going to know that you're doing it wrong. So you've got to live with the volatility. You are not necessarily going to get your prediction right. You're not necessarily trying to predict next year's bad debts. What you're trying to do is accurately measure the risk as of today. What is important is if you have followed a methodology that's compliant with IFRS 9 and is technically correct from credit measurement technique perspective, you've got an answer that's defendable and you can explain where you came to that number from and why you had that number, even though it didn't prove to be the correct actual number. So that is my parting thought, and I'd like to just throw things open to some questions.
Perfect. Thanks so much, Lawrence. I see we've got about 6 minutes left. So if I can invite Rosh to come back on screen, that would be fantastic. And we'll try and get to as many questions as possible. Let's have a look. So we did have a couple of questions raised during the registration process. And I think the first one by Etienne Buertes, and Lawrence, I think you may be able to speak to this one. He's asking, I'd like to know more about credit risk related to non-listed entities.
Yeah. So
you're on mute, Lawrence. Oh, there you go.
Okay. So yes, it's always a challenge to measure the credit risk on non-listed entities. As I did allude to, we use a tool provided by Moody's Analytics, which is widely used within the international banking community. It's in very wide usage in South Africa, which quantifies the probability of default and loss given default from a company's financial statements. So as long as we have access to financial statements, we'd measure from that. Without a model such as that, what the only technique you can really use is to benchmark to rated entities and to apply the rating methodologies that the major rating agencies, Moody's Investor Service, S&P Global, Fitch Ratings, if you look at their websites, they do publish their rating methodologies. They are technical documents. You do need a fair amount of credit expertise to be able to do it, and you would benchmark to those to get to ratings, and then you need to know how to transform a rating into a probability of default and measure the loss given default.
Fantastic. And just to the audience, if we don't get to all your questions, we will definitely answer them and revert back to you via email. So I see another one came through from Ches Francis. Is 60 months check a largely accepted global view? Rosh, I think that was aimed at you. You did bring up some of this during your session.
So I think obviously the more information you have, the better. The greater the history. You do want information that will take you through the entire credit cycle, the ups and the downs. But I think that it sometimes proves to be fairly difficult to go back further than that. So where we are able to get more information, we do that. Sometimes as a starting point, we would get 7 or 8 years information if it's easily accessible. And I think you've got to weigh up the cost and the benefit. So there's no real hard and fast answer on that one. Certainly 12 months is much too short. We wouldn't even venture an opinion. 2 years, also really challenging and hard to defend. You need to start looking at through the cycle averages.
Perfect. Thanks, Rosh. Another one came through from Samuel. What methodology of IFRS 9 can an industry like security implement? So, Lawrence, you want to take that one?
So the security industry, they're going to have a diverse data book. Depending on which sectors they operate in, I think there are fundamental differences in how you measure the credit risk on corporate or commercial debtors as opposed to consumer debtors. So that's very important to understand that. You might need to segment your book into 2 different sectors. We know that we've certainly experienced within the security industry, the very large players, a lot of them have significant loan books of employee loans, which can often be material and require expected credit losses on. They're effectively operating like a mini micro lender, giving payday loans to their employees, and that might need to be tackled as well. I think that just the interesting thing from the forward-looking perspective, the security industry, their clients are probably a bit of a bellwether for the economy. So it's I would use as your forward-looking macroeconomic variables, economy-based measures in general for the South African economy.
Fantastic, thank you. I see we have about a minute to go. So again, as mentioned, we will definitely come back to the audience with responses to your queries in the next day or 2. And I apologize that we couldn't get to all of the questions. So again, to Rosh, to Lawrence, and to Narishni, thank you so much for your time. I really appreciate it, and for the fantastic insights into IFRS 9. To the audience, in the next few weeks, we will have a couple more webinars coming up. So I will share them with you in a second. If I can ask the panel to just go off camera for a few seconds, that'll be fantastic. So we've got SA's Finance Leaders coming up on the 15th of September. And then we have Cash in Times of Crisis, hosted by Nedbank CIB, and that will be on the 17th of September. And then the following week, we've got Plan to Win on the 22nd of September. So do go ahead to cfo.co.za//events and do join us for our upcoming events. Thank you again to the panel and thank you to the audience. We hopefully will see you soon. Thanks, everybody. Bye.